In this recording, we're looking at the January 2018 question 1, which is called Fahela Limited. So particularly your question 1 and your interim assessment for CAP2 financial reporting is going to be over half your exam. So if you look at this for 2018, it was 55 marks. So that's over half your time, so just over about 50 minutes in length. And what you'll notice is as you practice through these question 1s, is it's as much about your knowledge of the standards, so all the various standards that are examined in the notes, but also about exam technique. Because you will be under time pressure here. And one of the common bits of feedback from the examiner reports, which are important in this interim assessment, is poor layout and poor labelling of workings. So what I want to focus on in this recording is your exam technique as much as your actual knowledge of each of the standards. And what I'm going to take an approach is 4 steps. First step should always be read the requirements. So figure out exactly what statements am I asked for. For example, is there a statement of changes in equity there? How many marks? It usually doesn't vary off 50 to 55. And are there journals? Now, usually in the interim assessment in January, they don't ask you journals in question 1. But similar in question 1 in the June exam, they do. So it's no harm to practice your journal entries. Once you've that done, do a high-level review of the trial balance and the notes. It's important you mark them up as you go. So mark up your notes, look for key dates, write down the standard that you see for each of the notes or anything that you might look unusual. Because once you're 15 or 20 minutes into the exam, you'll forget about the things you've written. So get that discipline of marking it up, and I'll show you as we go down along. Then leave space, and some people might even start the template. So you'll see now in the interim assessment, you're given a question booklet, which is where the questions are, but you're also going to be given answer booklets. And that's going to give you pre-populated lined items for where the P&L, the balance sheet, the statement of changes in equity should go, and it also gives you a load of pages for workings as well. So some students, what they like to do once they've read through everything is to go straight and set out a template, because they kind of look the same for every question, and maybe leave a couple of space lines every so often just in case an extra item comes up. And once you have that setup done, then you start your workings and you label clearly. So we're going to take that now. We're going to take a bit longer than you would have an exam, but it's more so to emphasize the approach and the discipline. Because remember, you have to practice and practice this at home under exam pressure, because it's quite a tall ask to get this done in the 45 or 50 minutes. That's what's expected of you in the interim assessment for FR. So this question then is called Fahela Limited. Just have a quick look. They give you straight away a balanced trial balance. And I'm just going to point out a couple of items that I think you should be looking for on the day of the exam. So for example here, you're given an allowance for bad debts. That will be an opening allowance. Right? So typically when you're given an allowance, the trial balance, that hasn't been adjusted for movements during the year. So you're probably going to have to adjust that at some stage. Your accumulated depreciation is for the end of last year. So this is 2017. Because remember, if you go back to the questions, we're asked for 3 statements now. So all at the end of 17. Sometimes you're only asked for A and B, statement of profit and loss and statement of financial position. Other times you might be asked a statement of change in equity. Nice marks, so don't throw them away. We'll come back then. So that's at the end of last year. Cash and cash equivalents, they don't need to tell you it's an overdraft. You should know if it's on the credit balance side, that means it's overdrawn, it's a current liability. This is something I would highlight because it's probably going to be an issue with it. Current tax receivable from last year. So it's carried forward. It's probably going to be an under or overpayment. Everything else looks fine. That's opening inventory because it's the end of last year. So just always highlight the key things. Share capital, gain accumulated depreciation at the end of last year, and retained earnings at the end of last year. And we have a reval surplus. Often there can be adjustments related to that. We'll just have to see as we go along. So it's no harm having your little highlighter or whatever system you have, but get a system in place to mark them up as you go along. Right, so we have an idea there. As I come down then, I would always advise students have a quick read through each of the notes, because sometimes the notes can be linked. And if you do note 1, for example, without reading note 2, you'll have to go back and redo it again. So it does save you time in the longer run if you set up the question correctly. And on my first read through, I'll be jotting down, this is an IAS2 issue, and I'll be highlighting any key dates. So I wouldn't necessarily be doing all the workings out, but I was setting myself up to know, I know where the hard workings are, and I know which are the linked workings. So you can decide then and go down through each of them once you've read. Now this won't take as long as we're taking here, but it's to give you an idea of the approach to take as well. So if we look at here, then they tell us the closing inventory, but importantly, they don't give us at the year end. They give us 2 days later was this amount, and then there was sales between the year end and that date. So we're going to have to adjust that. That straight away, if you know your standards, remember this is closed book for the interim assessment. Piece the main exam is open book, but the closed book for the interim assessment, that should be telling you straight away, I know inventory is IAS2, and you're writing it down. So we have some adjustment to do there before we bring in closing inventory. Remittance from a trade receivable of 6.4 was correctly accounted for in cash and cash equivalents, but they debited trade payable in error, and the balance amount was included in retained earnings. And then they talk about the allowance for bad and doubtful debts. We have 2 adjustments there, dealing with the 6.4 that was incorrectly done, and then adjusting the allowance for bad and doubtful debts. So remember, a good student now will draw a line between that part of note 2, and we have an opening balance and allowance. Sometimes that's called a provision of 8.6. So a good student will draw them together so you won't miss that when you come back. Because we'll come back 10 or 15 minutes later, we'll forget a lot of these things because we're looking at so much in such a short space of time. So it's all about that exam technique to guide yourself through each of the stages. We'll come back to each of those. Receive full payments for the share issue in December 17, and they debited bank when they credited revenue. So we know that's not correct. We're going to have to readjust that. And a good student will note there, if I have a share issue, that's going to impact part C as well. So you might put a big label there, statement of changes in equity. So just trying to map, you're getting marks every time you put these things in. When you issue shares during the year, you're going to have it in the statement of changes in equity. So cash sale into the accounting system of 40,000 instead of 4,000. So there's an error there in terms of accounting. We have to adjust that error. Right? So we'll do that in due course. Income tax bill for this year was 32, and at the end of this year, a payment of 20,000 was made towards this. No accounting entry has been made in respect of these transactions. Right, so we have to deal with that in terms of the tax bill. They also tell you that a revenue audit revealed that they had to pay additional tax of 15.6 related to last year because of an intentional miscalculation. The key word there is intentional. This was paid during 2017. Right. And Fahela bookkeeper, they debited distribution costs credit bank. Now, when you make a material intentional error from prior year, that's going to be covered under IAS 8. So we're going to have to go back there now, and we're going to have to adjust as a prior period error because it was intentional, an intentional miscalculation. So all these are to do with tax, and I would draw a line then between note 5 and the balance we have up here, current tax receivable. We haven't been told that that's come in, so we assume that's still outstanding, so we're going to net those off when we get the statement of financial position. So you draw a line between that highlighted amount and note 5. Note 6 then says, Fahela revalued its buildings to their net carrying value in the above listed balances last year, and their useful life was changed from 40 to 25 years. At the end of this year, they revalued it again to the net carrying amount. So that's a tricky one. So we have to deal with a property revaluation under IAS 16. So I just wrote down IAS 16 there, and we'll come back to that in due course. And of course, what you remember is this is 6 and 7 are linked because buildings are charged depreciation based on the revalued amount. So we'll come back and look at those. No depreciation in year of purchase, full in year of sale. And depreciation goes to cost of sales. So we'll go back and we'll do 6 and 7 together, depreciation and the reval, all under IAS 16. And last but not least then, note 8. Purchased a building halfway during the year, which is paid by cheque. The useful life of the building is 25 years, and they've debited purchases, even though they bought a building. So actually, 6, 7, and 8 have to be all done together. Because if you didn't debit property, plant, and equipment, you wouldn't have depreciated. So see the way there, if you just dealt with 6, without dealing with 7 or without dealing with 8, you have to redo them again. So I draw a circle there, all of 6, 7, and 8 have to be done together, because they're all linked together. So what we've done there is we've looked at the links, we've looked at the links to the trial balance, the links between the notes, and also we just jotted down each of the relevant standards as we came across them. So that's essentially your step 1 and your step 2 is have a quick read of the requirements, have a quick read of the information given. What some students like to do now is they'll jump to the answer booklet and they might set up a template statement of profit and loss, put in the revenue, the cost of sales line, the gross profit, down along, just slot them in as they go. Or some students will wait till the end to do that. That's entirely up to you. What we're going to do is we'll leave that till the end, And we're going to start here by looking at the workings. So I'm going to take them in order. You don't necessarily have to take them in order on the day of the exam, because you might think, oh, note 1 seems very tricky. I'll leave that blank and I'll come back to it. That's fine. There's no point getting caught up in a hard one and not being able to solve the ones that you understand first. So be strategic in terms of your sequencing as well, but of course don't leave one out by accident. So working 1 here, we know it's IS2, closing inventory. So your closing inventory was 360,400. Now that was on the 2nd of January 2018. So we know that is not the figure that can go in our 2017 accounts. The reason being, we need it at the 31st of December. So this is what we call a rollback procedure. Because what you're going to do is you're going to roll it back from the 2nd of January back to the 31st of December based on the movements. You know, between that date and the year end, you sold 36,000 worth of sales to a credit customer, fully accounted for the sale at that date. That means the sale is fine. It should have been in next year's accounts. And the closing inventory at the 2nd of January excluded, which is correct. But we know then, well, if we made that sale after the year end, that means if I can reconcile it back to closing inventory at the 31st of the 12th, 2017. So I can actually, what we call roll back. You're rolling it back 1 year, or 2 days in this case. So what we look at here is, these goods were sold on the 1st of January. That means they weren't there on the 2nd of January. They're not in here, but they should be in the 31st of the 12th. So we're going to add them back. So you're going to do the adjustment. You're not going to add back 36 because that's the sales amount. You only want to add back cost. So you're going to add back 36,000. And be careful of margin and markup. They earned a margin of 25%. That means the cost was 75%. Margin as a percentage of profit. So they earned a quarter profit, and that means 36 times 3 over 4 is 27,000. So your closing inventory at the year end is 387,400. That's what we call, it's a common question called a rollback. You did the stock count after the year end, and you're rolling back between sales and purchases to figure out what was there at the year end. And the debit and credit there is debit, inventory, current asset, and credit cost of sales. 387,400 and 387,400. Now I said this is entirely up to you. What some students do now is they will have a working open for cost of sales already, and they'll slot it in because you have a number of adjustments going into cost of sales. And some students might have a template for the statement of financial position, current assets open, and they slot in that figure. That can be quite efficient and slot them in as you go along, because we've nothing to do with closing inventory anymore. We're finished it after this. So that's entirely personal preference what way you want to do it. Just make sure you practice your technique and you can finish the question in the time allocated. Working 2 then, we're dealing with 2 or 3 elements here. The first one is to deal with the 6,400. So remittance of 6,400 received from a trade receivable was correctly accounted for in cash and cash equivalents. So the debited cash and cash equivalents, or debited bank, but they also debited trade payables. And the balancing amount was included in retained earnings. Now this is a bit misleading the way the solution works. So we're assuming the balance here was in your revenue, because that's where retained earnings come from. This retained earnings figure here is at the end of last year. So what they mean by retained earnings here is they mean it went into revenue and then it fell to your profits. So that's a bit misleading. So I appreciate if some students went wrong there. So what happened was that this is not the adjustment, this is what has happened. They debited bank, same as cash and cash equivalents, they debited trade payables, and they credited revenue. We said you mightn't have picked up on the revenue. If you said credit retained earnings, you're not a million miles away. It's just probably poorly worded in the question more than anything. 6,400, 6,400, and then 12,800. So what should have happened here, you should have just debited bank and credited trade receivables. So we've clearly done some things wrong here. So the adjusting to remove it will be to credit trade payables. We know that's wrong. It shouldn't have been done there. We're going to debit revenue because we know that's wrong. This has nothing to do with revenue, it's to do with receivables. And in the balance there will be credit trade receivables 6,400. So that's your adjusting figures there. No harm to work it out. What has happened, what should have happened, if you wanted to write it down, was debit bank, credit trade receivables, and you compare and contrast. But they are adjusting journals now. They are not adjusting ones. That's what's happened already. They're just telling you that in the question. And what they tell us then also as part of working 2 is they want the allowance for bad debts to be 6% of receivables at the year end, and the movement goes to admin expenses. So we have the old provision, which is in the trial balance. Your old provision here was 8.6. So you go back up, that's the one I flagged already. You're given the opening balance, it's always on the credit side. The new provision will be 6% of your trade receivables, which in this case are 347,600. Now this is where they get tricky. Watch for it. You've just adjusted trade receivables. They are overstated by 6.4, so you need to adjust that. So that's why they come in a particular order. And if the examiner is feeling really mean, they'll give you that paragraph first and then the 6.4 after, because one impacts the other. So that's why it's always a good practice to read down through the full question and all the notes before you jump into the calculations. So here then it is 347,600 minus 6.4 times 6%. So your new provision is 2472. That means you have an increase. And the increase is 11,872. Right, so that's the increase. Remember now, this, you're told the movement goes to admin expenses. An increase is bad. You're debiting admin expenses and you're crediting your bad debt allowance, otherwise known as your bad debt provision. 11,872, 11,872. So again, if I was a student who had a different technique, I would have a working opened up for admin expenses, slot in it as I go, and I would update my trade receivables now. So I know from having read through all the rest of them, there's no other impact on trade receivables. So what you could just do there is the trade receivable figure in the SOFP, and if you had a template set up, you could slot it in straight away, will be a 347,600 minus the 6.4 we've adjusted for already. And be careful here, net of the full provision. You always take off the full provision in the statement of financial position, only the movement then goes to the P&L. So that's the figure we're going to be quoting in current assets. So we've actually two figures for current assets already, trade receivables and our inventory. And some of you could have those slotted in and save a bit of time at the back end. Just to avoid switching between screens now, we'll keep it all towards the end. But just think about those things for exam technique as well as you go down along. Let's just double check that. 347,600, 4 is 320,728. So that's our working 2, nice and clearly labelled for the examiner. And we'll cross-reference them then when we're doing our statement of financial position as well. Because remember, the financial statements, the big feedback from the examiner is students are not labelling their workings clearly. So we had a share issue at the end of the year. We've already labelled this statement of changes in equity. We know it's going to go in there. They've debited bank, which is fine. They shouldn't have credited revenue. This is credit ordinary share capital and credit share premium. So you're going to debit revenue. So that revenue is wrong. So that's another working for revenue. Shouldn't be in revenue. When you issue shares, you're going to credit the ordinary share capital and you're going to credit the share premium. The ordinary share capital is going to get the nominal amount, and that's why they told you it was €1 each in the statement of the trial balance. So you see there's linked together where the information is given. 40,000 shares at 125. Now, of course, here, what's wrong is they valued at 40,000 times 125 is actually they got 50,000 in. They've only recorded 40,000. So the revenue is wrong. You should be crediting ordinary share capital 40,000, and that is 40,000 times 1. All right. You should be crediting the share premium 10,000. That is 40,000 times 0.25. So whatever you issue, that's the market value. Whatever you issue above the nominal value goes to this thing called the share premium account. So that's credit share premium. So the balancing figure here then is to debit bank 10,000. And that's because you didn't raise €40,000, you raised €50,000. So the bank should be debited an extra 10. So bank and cash equivalents are used interchangeably here. So again, we now know, good student will say, I'm finished with ordinary share capital. So my ordinary share capital is going to be 40,000 plus the opening balance of 60,000. So it's going to be 100,000 in my statement of financial position. And you might slot that in as you go along. We'll just leave it till the end. And my share premium is going to be the 10,000 adjustment there, plus 10,000 from the trial balance as well. So the closing balance there is 20,000. So whenever you get the chance, I would always do up them little subtotals as you go along. It makes finishing the question an awful lot easier. And that's where you'll be tight for time. A lot of them are going for the workings, but there is a cohort of marks that are going for finishing the question out and presenting it professionally in terms of labeling your workings so the examiner can see where figures are coming from. All right, so that was working 3. Working 4 then, a cash sale has been entered on the system at 40,000 instead of 4,000. So they've made an error here. They've over-recorded cash sales by 36,000, the difference. Right? So it's an entry error. So what you're going to do there is debit revenue, because sales were over-recorded by 36,000. That's another adjustment to revenue. See, we have a lot of adjustments there to revenue we have to track. And you're going to credit bank. Because remember, it's a cash sale, so you would have debited bank too much, 36. So some of these can be nice and straightforward. Get your marks and move on. Because you're going to need those, that bit of time to do the longer ones. That was a nice one. It was overstated by 36, the difference between the 40 and the 4. So you reduce your revenue and you reduce your bank. Next one then is working 5. And this is to do with tax. And we said this is linked back up then to the tax receivable up in your trial balance. So we're told here the income tax bill is 32,000 for 2017. So what we do with that, debit tax expense, credit tax liability. That's fine. So you can do this. I'm just doing it in separate steps. You can do it as a net journal if you wanted to. Tax expense is amount to 32,000. That's fine. Payment of 20,000 has been made towards that. So actually of that 32, you're going to debit tax liability, 20, and you're going to credit bank, 20. Now you could have netted those journals together and come up with a net liability of 12. That is fine. Either way will work, as long as you have the expenses 32 and the closing liability there will be 12. So in terms of tax in the SOPL will be 32,000. But be careful now, tax in the SOFP will be 6,000 of a liability. And how do I come to that? Well, you have a net liability left here of 12,000 that you still have to pay, and I netted off the asset of 6. So they don't tell you, so you can make a bit of a judgment there. If you left that 6 as a separate asset and put 12 as a liability down the bottom, that's fine as well. I just did 12 minus 6 there to get to 6,000 current liability. So there is a bit of subjectivity there. There's no mention of this or what's been done, so we're assuming it can be left in the question. Other times you can adjust it out for an over or under provision from last year. Just depends on the wording in the question and what stance the examiner has taken. So leaving it as a net liability of 6 or an asset of 6 and a liability of 12, both would have been fine in this instance. Related to that then, there was also corporation tax for last year because of an intentional miscalculation. So in working 5 as well, this is a prior period error. And the key point here, it was intentional. And under IAS 8, that must be a PP, prior period error. So you must go back and adjust the 2016 accounts because it was intentional. So you shouldn't be debiting distribution costs for this year because it relates to last year. So what you're going to do is you're going to credit distribution costs because they shouldn't have been debited. And instead you're going to debit retained earnings. Now this is an important one because it comes up the odd time in your question 1 is when you have a prior period error, that is going to show up in the statement of changes in equity. Right, so put a big label there, SOCE. Prior period errors are presented a particular way in your statement of changes in equity. It's not debited to the P&L this year. It's a direct adjustment for an intentional oversight from last year. and that's covered in IAS 8. So we've cross-referenced there working 5 in that regard. So it's nice ones. IAS 12 covers the normal tax, and IAS 8 is here because it's a prior period error. So that's bringing us on then. You have working 5 done. So we're nearly there with the workings. So sometimes you can work through them quite quickly. Is working 6. Now we said working 6, 7 and 8 are going to be done together because they're all to do with PPE. So we purchased a building which is incorrectly treated. We've charged depreciation and we have a revaluation as well. So let's start then, the first thing, with the property, plant and equipment in terms of the acquisition, because that's one of the more straightforward ones to start with during the year. So they paid check 1st of July, 200,000 for building, but they treat it as cost of sales through purchases. So we know that's wrong. We should be crediting purchases and you should be debiting PPE. So PPE should be 200,000 larger and purchases should be 200,000 smaller. So it's no harm to start with the stuff that happened the first, because that's going to have an impact then on the rest of the approach as well. So that's our first one. Our second one then is depreciation during the year. So for buildings, no depreciation is charged for buildings in the year of purchase. So what that means is you don't depreciate this 1st of July. So it actually didn't have an impact. The examiner tried to help you along. But what you will be doing is charging depreciation for the buildings here. You're told buildings are charged on a revaluation basis. So on the date, the estimated useful life of buildings was changed from 40 to 25 years. So at the end of last year, they revalued it. So it now has a cost of 2145 and accumulated depreciation of 845. So the net book value at the 1st of the 1st 17 was 2145 minus 845. It was 1.3 million. Right? And you're going to charge depreciation then, and that's going to be charged based on the updated, which is 25 years. So 1.3 million divided by 25, you're charging 52,000 depreciation for 2017. Now, this was quite tricky, the way the examiner worded it. They said they revalued its buildings to their net carrying value. So actually, the revalued amount is the 1.3 million at the end of 2016. Usually, we would present that by clearing out the accumulated depreciation and adjusting the cost account. They haven't. So it's just a different way of presenting it. The key point is you should be depreciating the revalued amount, which happens to be the carrying value. That is the 1.3 million. That was quite tricky the way it was worded. So then the net book value at the 31st of the 12th of 17, right? That is going to be here. You have your net book value from last year, take off your depreciation, but just be careful now, you have the addition as well. You're going to add in the 200,000, which we had above. So your closing net book value for your buildings, sorry, I'm taking off this one, is, let me see here, I'm taking off the right one. So you have 1.3 minus your 52 plus your 200, 1148. That is your buildings at the end of the year. Now they say they revalue them to the same net carrying amount. Essentially the net book value is going to be left at 1448. If you want to debit accumulated depreciation and credit the asset cost account, that's fine. But there's actually no revaluation gain or loss because all they're doing is revaluing it to the carrying amount. That depreciation for 25 years will not impact until 2018. We've already charged depreciation for 2017. So just watch that and go back over, look at some of the past papers. That's a tricky one where some students are getting caught with the way the examiner words those revaluation questions. So the debit and credit there is to debit cost of sales, 52,000 for depreciation, and you're crediting accumulated depreciation, 52,000. But we know the net book value for buildings will be 1.448 million at the end of 2017. It's unusual here, you're revaluing it, but there's never going to be a gain or loss because the revalued amount is the carrying amount. So there's no difference. The only difference is when you charge depreciation, then you're always going to be charging on the net carrying amount, which essentially is very similar to charging depreciation on reducing balance method. It's just a slightly complex way the examiner uses to word it. Then plant and equipment, P&E. You have depreciation for the year. That is going to be 15% on straight line. 15% of plant and equipment is 860 times 15%. So your depreciation there is going to be 129,000, and your net book value at the 31st of 12, 2017, that will be your cost, which is 860, minus your opening accumulated depreciation, 475, minus your depreciation for the year. So it's no harm doing these little calculations in the workings, and you can cross-reference in then quite quickly. So your net book value that you're going to add to these two together is 256. So PP at the end of the year is the plant and equipment plus your buildings. So your statement of financial position figure, all you have to do is slot in a single figure, 1704, and cross-reference working 6. That's why it's always a nice idea to do those as you go through the question to make it a lot simpler. And your debit and credit for the depreciation here is debit cost of sales, 129. Credit accumulated depreciation, 129. So you have most of your workings done then, and it's good practice, nicely laid out. We actually have a lot of the workings done, so when we go to finish the financial statements, we can slot in a lot of the things as we go along. What I would always suggest to students is before you now transition to financial statements, I would open a final working. Now some students will do this as the first working, some students will leave it till the last working. What you're going to do there is do cost of sales, we'll do revenue because there's a couple of workings, do cost of sales, admin expenses and distribution costs. Now some will say, I'll just do that working 1 and as I find the adjustment slotted in, that's fine. Others will leave it till the end and go back and check and slot them in as you go. Right? The only danger is with some of these, you're always going to have workings for a lot of them. And if you try and leave them in the financial statements when you're doing it on the face of the financial statements and try and put brackets, it can get quite messy quite quickly. It's very good practice to try and do it like this, as the examiner can see exactly where the figures are coming from. And you keep your face, your financial statements, and there's your presentation marks quite neat. Just slot in the trial balance figures first. Revenues trial balance was 24,457,840. Cost of sales, we don't have a trial balance, but we have a trial balance for opening stock. We have a trial balance for purchases. So we can slot in those to cost of sales, 286,400. And we have purchases, which are given somewhere here. Just come down along. Purchases, 1,245,780. Opening admin expenses are up here, 211,240. And opening distribution costs are here, 382. Just showing the examiner, this is my starting point, and you go through each of the workings then and slot them in. So when we actually come down here, we've single figures to slot in, cross-referencing working 7. Nice and neat, and more importantly, easy to follow, particularly for the examiner, which has been a big point when you look at the examiner reports over the last couple of sittings. So look at working 1 then. We're going to bring in closing inventory, 387,400. So closing inventory is going to go in here. Working 1, closing stock, and you're going to do minus 387,400. So remember, it's opening stock plus purchases minus closing stock. So keep going back up to each of the workings just to double check. So let's see, if you had this open up at the start, you might have to avoid going back over things. The general rule is you'll go back over workings a lot, you're going to lose time. So here then we have adjustments. We're going to debit revenue 12.8. So reduce the revenue 12.8, working 2, and increase admin expenses 11.872 for the bad debt provision. So 2 adjustments to working 2. So you see the way it's nice to lay it out as well. That's going to be minus 12.8, and that's going to be plus 11.872 for your revenue and your admin expenses. Come to working 3 then. We're going to reduce revenue by 40, and working 4, reduce revenue by 36. So working 3, working 4, reduce revenue by 40, and reduce revenue by 36. Okay, so just coming back up, your cross-referencing go along. Minus 40, minus 36. Here, no adjustment to the items we're looking at. But credit distribution costs, that means reduced distribution costs. Credit expense is reducing expense, working 5. So working 5, that is going to be a minus 15.6, which is reducing your costs. All very neat so far. Working 6 then, reduce purchases 200,000, increase cost of sales 52, increase cost of sales 129. So 3 separate adjustments there for working 6. So cost of sales, you're going to increase it 129, and you're going to increase it 52. And the final one for working 6 then as well is you're going to reduce your purchases because they were incorrectly classified as purchases when in fact they're actually property, plant and equipment. So you're going to minus the cost of sales, which reduces it down. And that's always gone through all of our workings. And the nice thing is then we have the financial statement items, or the final items here, which we can just slot into the financial statements. So you still need to leave a bit of time at the end to finish it off, but we now have a lot of the figures completed as you go. So the revenue should be 236,940, cost of sales 1,125,780, admin expenses, and distribution costs. So straight away, you've 4 figures done very quickly, and you've nearly your income statement complete before you even started. So that's a big thing about these questions. You will be under time pressure. Look at the approach you're taking to questions. Do out something like that. Make it a lot more approachable, and cross-reference the workings into the examiner. All I'll be putting beside each of those, the financial statements, is see working 7. Nice and neat. Don't waste time, and the examiner can clearly see if you want to figure out where a figure is coming from. So in preparing the statements then, you might have just a template. Some students have a template done, but it's just revenue. You're going to do cost of sales, gross profit, and then you go down along. So some students might write those at the start and slot them in. You can wait till the end as well. Admin expenses, distribution costs. Then we have finance costs, and that will get us to profit before tax. And then profit for the year. So you can always leave lines every so often if you're not sure exactly where they're coming from. But I'd always, and this is important now, I'd always put a column here, just calling it note. So where you're getting your references, where you're getting your workings from. So that's going to be working 7, working 7, working 7, and working 7. So all of them are done straight away because we've them all done in a single working. So I don't, it's nice and neat here. My revenue, I've said, is 2369040. My cost of sales, be careful now, your cost of sales is the negative figure. Cost of sales is 1,125,780, which means my gross profit is 1,243,260. But you can see, if you do it well at the start, 5 minutes will finish out a lot of the financial statements. But you are asked for the financial statements, you have to finish them off to get your marks. Admin expenses, 223,112. I'll just make sure I keep all these the same format. And then distribution costs are 366,400. So that's a number of them done. Finance costs, we didn't do anything with finance costs, so all I put there is trial balance. The finance costs are 16.5. Just to show the examiner, and what I would do there is tick them off as you cover them. As something has gone in, tick it off. That's gone in, your distribution costs are gone in, your finance costs, because invariably when something doesn't balance at the end, it's something you've left out. So get that habit of ticking off for completeness everything that's gone in. So that gets me my profit before tax. I can't see any other expense. Just have a quick look through, see there's no other expenses there or any other income. My profit before tax of 637,248. And my tax expense, if you remember, we have done in the workings. Working 5, tax expense for the year, 32,000. That's all I slot in. Working 5 minus 32. So your profit for the year is 605,248. And that's your first statement done completely. No long workings shown in the face of the financial statements. Nice and neat. And the examiner can clearly follow what's going on. We then go to the statement of financial position. Again, some of you may have set up a template already, or some of you may want to pause it now and see can you balance it before you look at my approach. So you have non-current assets, you'll have current assets, and then you'll have total assets. So don't try and take shortcuts now. The examiner will want to be looking at the subheadings. There will be marks going for layout as well. So here you have PPE. We've done this already as a working. That makes it a bit easier. And that's why I always say try and do those little subtotals at the end of each working. Makes the finishing of the financial statements a lot quicker. Subtotal here was 1704 going to statement of financial position. And that was working 6. All I put there is 1704. And that's slotted in. There's your non-current assets complete. Current assets, we have a couple. We have inventory, which is from working 1. 387,400. You have trade receivables from working 2. Just be careful now if you want to go back up to trade receivables in working 2 with a number of adjustments. The trade receivables, as we've done the subtotal, is 320,728. 320,728. And we'll just look down along here. Cash and cash equivalent are an overdraft. So they're going to be down in liabilities and we have to adjust them anyway. And then nothing else seems to, there's no prepayments or anything like that. As I said, you might put the current tax receivable in here if you wanted to. I'm netting it off against the liability in current liabilities. So that's entirely up to you what way you want to present it. So your total current assets there come to 708,128 and your total assets will be 34,12128. Or 24,12128 should I say. That's half your statement of financial position done. So it takes a bit longer to set up at the start, but towards the end of the question, you will finish it a lot quicker. That's the big benefit of that. So then you have equity and liabilities. You have ordinary share capital, share premium, retained earnings, and you have revaluation surplus. And then you will have non-current liabilities, and you'll have current liabilities. Just setting up the headings to the start. And again, as you slot in a number, tick it off, either from the workings or from the trial balance. So you don't omit anything, because everything that goes in is worth credit. Ordinary share capital and share premium, we remember, hopefully we've done a working. You have working 3, we've done our little subtotals, 100,000 and 20,000. Working 3, 100 grand and 20 grand. Working 3. They're slotted in. Revaluation surplus actually didn't change because when we were revaluing it, we only ever revalue to the carrying amount. So it's an unusual revaluation policy. So that means there's never going to be a reval gain or loss because the reval amount is always the same as the carrying amount. It's quite unusual, but popular enough with the examiner at the interim assessment. So that's just from the trial balance, 24,000. Now here's where you might want to do a separate working, or you might just put it in the column to show the examiner. Your retained earnings here will be the trial balance, retained earnings 776,080. You're then going to take off the 15,600. So coming for your workings, we debit retained earnings here. If you go back along, debit retained earnings 15,600 from working 5. So I'm going to say there minus working 5 and plus your SOPL. Don't forget now, and this is why I'll put it in bold, the profit for the year impacts your retained earnings. Be amazed the amount of times in an exam students will just give the 776. That is the retained earnings at the end of last year. Retained earnings are moved up or down by profits for the year or any dividends. There's no dividends here, so it's just the adjustment. So we have 776,080 minus 15,600 for the prior period error and plus the profit for the year 205, or 605 should I say, 248. So your closing retained earnings there should be 1365728 and your total equity 1509 728. And we'll need that section here. You're going to need that for the statement of change in equity in a second. But that's a key one. Whatever way you want to show the examiner, but to show them where the figure is coming from. Just double check then if we have any non-current liabilities. We have a debenture payable in 3 years' time. So we'll put that in there. Debenture, taken from the trial balance, and that is 330. That's okay. No other non-current liability there. Current liabilities, we have trade payables, which we had no adjustment, so just trial balance, 496. Anything else there that looks like a liability? There's none there. So your bank, call it cash and cash equivalents. Now let's do a bit of an adjustment to bank, because there could be a number of adjustments from our memory. So you put in brackets there, trial balance figure. Come back to our workings then. In this case, there's no adjustment to bank, because bank has already been done. That's fine for working 2. Working 3, you're increasing bank by 10, debit bank. Working 4, you're decreasing bank by 36. So just be careful here now. We are in liabilities. So increasing the bank means reducing the liabilities and increasing 36. So if you want to cross-reference the workings instead, probably be easier. That is going to be, just double check it here. Working 3 and working 4. So here we'll do minus working 3 plus working 4. What else do we have then? You have plus working 5, because you're paying out of the bank that increased the overdraft. Plus working 5. And just double check then, there's nothing else I think in terms of that. Nothing here in terms of bank, nothing there. We have the working 5 in, we have working 4 in, and we have working 3 in. So they look okay. So we come back then to the statements. So we start off with an overdraft of 18,000. You reduced it by 10,000 because that's money coming in, which reduced your liability. You increased it by 36, which was incorrectly recorded. And then you increased it by, just check working 5 again, 20,000 because you paid your some element of the tax. So 64,000 is your bank overdraft at the end of the year. Start off with the 18, take off the 10 money in, add back the 36 money shouldn't have been in there, and the 20 for the tax. And then finally we have a tax liability, which is coming from its own working. We look at here, our tax liability is working 5, and we said the net of the liability and the asset is 6. That's the way I'm presenting it from working 5. That would be 6,000. So your current liabilities then come to 566, and your total equity and liabilities hopefully will balance your total assets, so you know whether you're right or wrong. 2405, so be careful now, we're slightly off, so we need to double check where exactly are we gone wrong. This is a good practice to get an idea. Just look at the difference. So 2412 minus this amount here, so you're off by 64. And if we remember, we go back, I've left out an item here. I should have credited trade payables 64. So that means these trade payables plus working 1, that's working 2 should I say, that'll be 496 plus 64. And now you're balanced. So that can be a useful technique where you're missing something, look at the difference. Doesn't always work out, but it can happen to, if you are missing one item, it can happen to spot it out very quickly. Right, so that's how to approach a statement of financial position. Nice and neat. The examiner can clearly see where the workings are coming from, and you'll get your marks. And the last requirement here, which doesn't always come up, but it's been a popular enough one in the last while, is a statement of changes in equity for a year ended 31st of December 2017. Now, the way this is laid out is whatever sections are in your equity section up here, they are now going to be in your statement of changes in equity. So you're going to have 4 columns for each of these, plus a totals column. Ordinary share capital, share premium, retained earnings, reval surplus, and total. Right, these are nice marks, but traditionally they're answered very poorly because students don't study them. Your starting point is always the 31st of the 12th, 2017, the closing balance. So what is the balance at the end of the year? That is coming from the statement of financial position. So you must always do the P&L and the statement of financial position first before you do the statement of changes in equity. So you're just copying in these. 100,000, 20,000, that's 24,000, and retained earnings, just copy it down, 1365 728. So that's your starting point. There's marks going for each step of these, so don't throw away the easy marks. We then have, typically what moves in here is if you have a profit for the year, which we do. So we put there profit for 2017. We don't have any dividends, so they would show here as well. Or we have a share issue. And I remember we labelled for the share issue already. That's going to be a statement of changes in equity. All right, so in this regard, your share issue, you had 40,000 going into share cap, and you had 10,000 going into share premium. And the profit figure, which is coming from the P&L, which of course means you need the P&L done first, that will impact retained earnings. And that profit figure we said was 605,248. So they're the movements you'll have during the year. So step 1, set up the number of columns to match the number of columns or the line items in your statement of financial position. Step 2, kind of unusually, is get the closing balances, which is from the statement of financial position, which are these 4 balances here. And then you work up. So you work up here to the opening balance. That must be 60,000, because 60 plus your 40 will get you to your, just do an underline here. 60 plus the 40 gets me to the 100. And that matches our opening trial balance, where we said the opening share capital was 60, and the opening here share premium is 10. No movement in reval surplus during the year, so the opening balance here must be 24. In this instance, we are saying, well, something plus 605,248 gets us 1365,728. So you take one from the other, means our opening balance on retained earnings seems to be 760,480. But if we go back, our trial balance says it was 776,080. Hopefully what you realize, remember before we had in a previous working, we had a prior period error. So that is where this is coming from. We debit retained earnings 15.6, and that actually shows up in this way it's presented on the statement of changes in equity. We call it a prior period error. So the first of the first 17 balances, and then we call these the restated balances. So these are the restated balances, and we call then in here the prior period error. That's the way you'd always bring it up in terms of IAS 8. So if you ever study in IAS 8, that's how you do it, or how you would adjust a prior period error. So there's no adjustments to either of these, so their opening balance is just going to stay the same. So 60 and 10,000, no adjustments, means the restated balances 60 and 10. This was an adjustment of minus 15.6, which means the opening balance would have been 15.6 higher, is your 776,080, which matches the starting point at the 1st of January. Then we say that should have been 15.6 lower because there was an error in the 2016 accounts. So our new restated balances is 760,480. And this is just 24 as before. So there is a lot of repetition, but the examiner does like to embed the IAS 8 questions into the overall piece as well. But that's how you get your full marks in terms of a statement of changes in equity. You start with the closing balances, which come from the statement of financial position. then the movements during the year. You mainly only ever have 4. Profit for the year, which we have, share issue, which we have, and the 2 that we don't have, dividends or a property revaluation gain or loss. We had a property revaluation, but there was no gain or loss. So therefore there was no movement. And the very much advanced topic then will be when you have a prior period error or when you have a change in accounting policy, when you have to retrospectively go back and change last year. That's a bit more advanced, but go back and look at previous papers. Some of those January papers do have those IAS 8 adjustments, which are required in question 1. So overall then, that question was looking at January 2018, question 1. In particular, what I want you to focus on now is the exam technique and the approach you take to the question. Of course, your knowledge of the standards are important, and you need to list off each of the standards that are examinable in the interim assessment and make sure you're comfortable with them, because it is a closed book exam. But you also have to practice under time pressure. How do you read the question? How do you mark up the trial balance? How do you mark up the notes? And how do you lay out your workings? And more importantly, is it easy for the examiner to follow your workings once you have presented them? The general feedback from previous years is poor exam technique is letting students down on question 1.